Hi everyone, today we're going to go over another spreadsheet, this time about mortgages and investing. A lot of people always talk about the idea of paying off your mortgage as early as possible, but sometimes we have to think about it in the sense of a trade-off, right? There's always an opportunity cost when it comes to investing versus paying off anything early, especially when it comes to a long-term debt, such as a mortgage. For those of you who don't know what a mortgage is, it's basically a 15 to 30-year loan for paying off a home. Part of a mortgage, and one way that the banks make money is charging interest on that mortgage. So basically you would pay extra on top of the initial amount that you borrowed. And this extra amount of money is paid off over a 30 or 15-year period, whatever the terms of the loan is. Generally speaking, if you do pay off your mortgage early, you pay less interest over time because there'll be less opportunities for the banks to charge you. Before you think about paying off your mortgage early, just make sure that you actually are able to do so without penalties. You can talk to your mortgage servicer to figure out if there are any penalties associated with paying off your mortgage earlier. As we mentioned before, one of the greatest benefits of paying off a mortgage is actually less interest over time. Lucky for us, I do have a spreadsheet over here where we can see that happening. So let's say we do pay off the mortgage a little bit early. And here we have a $300,000 mortgage and we put an extra $200 toward that mortgage. And let's say that mortgage is over a 30-year period with a mortgage rate of 4%. And on top of that, the mortgage payment is $1,432.25. Now, the original interest that you would have paid if you didn't put in the extra $200 would be $215,608.52. Now, if you did put in those extra $200 per month toward your mortgage, you would actually save $50,411 over the course of all those years. And you would also have the benefit of paying off your mortgage earlier than the 30-year period. We aren't going to get into the stock market portion of it just yet, but we will once we move further along in this video. Another key benefit of paying off your mortgage earlier is the idea that you won't be in debt for as long, right? Which frees up your capital to do other things, whether that's investing or just taking on another mortgage. There's also the idea of mental health, right? The idea that if you pay off your mortgage earlier, that's one less thing to think about, right? You don't owe money to anyone else and your house is free in the sense that you don't have to pay rent or mortgage on it anymore. But we really have to think about this in terms of a cost analysis approach, or what are the opportunity costs when it comes to paying off that loan earlier. Could that money that you used to pay off that loan early, that $200, been used to make you more money? In a sense, can you invest in another investment that would have guaranteed, or not necessarily guaranteed, but maybe generated more returns than the interest you would have saved? One key thing to think about is the biggest difference is that a mortgage, remember, is sort of guaranteed returns in the sense that that's interest you'll save no matter what if you paid it off earlier. But if you took that extra $200 and you put it in a different investment, there's a chance you might make more money. For the sake of this explanation, we're going to be using S&P 500, which on average returns 7%, and you can invest in a mutual fund for that. And we can go from there. Of course, it's not a guaranteed way to make money, but it's a pretty good chance based on historical data that 7% returned on average every year. And especially when we think about the period of 30 years, it's a pretty good chance that we're going to get 7%. Now, if we go back to that spreadsheet and we look at the stock market return rate, which is 7%. Of course, if you choose to use any other investment, feel free to change this number from 7% to any other number. And then once you have that number, you can start looking at this chart, right? It's minimized. And then when we look at these columns, you'll see that there's interest that you pay every month. There's a principal you pay every month. The extra that would have went toward the principal or would have been reinvested into the stock market. There's two approaches, basically. If you choose to use that $200 and put it towards the stock market, then you can look at column G, which is essentially how that money would have grown over time, over that 30-year period, if you just put the extra $200 toward the stock market instead of paying off your mortgage. The second approach is if you did pay off your mortgage earlier, then what would happen if after you pay off your mortgage earlier, you would start investing the $200 plus whatever your mortgage payment would have been into the stock market. Can you catch up? Now, that's the real question to ask. Right? Is it better? Would you make more money basically investing in the stock market from the get-go, from year 0 to year 30? Or would you have made more money and saved more in interest from basically waiting until you've paid off your loan earlier to start investing in the stock market? And you can see here that it really depends on what your interest rate is and what your stock market return rate is. If you play with these numbers a little bit, let's say if your mortgage interest rate was 10%, right? If you look at it like that, you're actually going to be losing money versus if you just put that money in the stock market. And it might be a better idea to just put the extra amount towards your mortgage. You would make more money paying off your mortgage and paying less in interest than if you took that money and invested it in the stock market. Right? Obviously, the higher the mortgage rate is, the worse it is to put money into the stock market versus if you had a high stock market return. Now, there's no happy number here, obviously. Every number is going to be a little bit different. But the idea being is that you have to ask yourself, is there a better investing opportunity out there? And for many of us right now, if you've purchased a home in the past 5-7 years, your interest rate has been likely on the lower side, probably less than 7%, which is the stock market return rate. And it might be a good idea to just not pay off your home early and just actually invest that excess money toward the stock market and the S&P 500. There's a good chance that at the end of the 30-year period, you'll have more money than if you just paid off your mortgage earlier. Since everything really depends on interest rates, because when we look at this S&P 500, really the average return rate is 7%, historically speaking. You could invest in something else, but it might be riskier and it might not be worth that risk. Personally, my rule of thumb is if the mortgage interest rate is less than 5%, or really any debt interest rate is less than 5%, then I probably want to invest in the S&P 500. But if the debt is more than 5%, then probably I want to pay off that loan earlier. Right? The reason why I'm not saying the debt should be 7%, even though the S&P 500 on average returns 7%, is because I want a buffer, right? 7% is on average, even when we adjust for inflation, but that 2% buffer is going to be really valuable when some years it might be negative, right? Or might be less than 7% because it can't happen. Average just means exactly that, average. Some years will be lower, some years will be higher. So I want that 2% to buffer for all of those negative years. Also keep in mind that just to be conservative, I did assume that my mortgage will have a fixed interest rate. And that might not be your case, right? If you have an adjustable rate mortgage, those are a little bit more trickier. But I would say, personally, I like fixed rate mortgages because I can understand where the interest rate is going. And also keep in mind that the returns in the stock market, like I mentioned before, do fluctuate from time to time. Hopefully this spreadsheet helped you out a lot. I will be sharing the spreadsheet in the link below in the description. So be sure to check that out, make a copy of it, and go ahead and just play with it. Right? Any field in the yellow, you can basically change and manipulate as you wish, and you can watch the numbers play out. The idea being is that you focus on the difference in stock market investment number and the interest saved number. Right? The idea is that you want the difference in stock market investments to be higher. And that means you would have made money. If it's a negative number, you're probably better off paying off your debts earlier. My rule of thumb is just 5%. If you have a different rule of thumb, good for you. Right? Just make sure that you understand how these interest rates play out over the long period of time and whether it's worth it to pay it off earlier or to invest in another opportunity. Good luck, and I hope this spreadsheet helped you out. Feel free to leave questions, and I'll be sure to get to them when I have time. Anyways, be sure to like and subscribe, and I'll see you in the next one.